What if filing bankruptcy was not the end of your credit, but actually the beginning of rebuilding it? Thousands of people have gone from a discharged bankruptcy to a credit score of 700 or higher in around 2 years. Today, we are going to show you exactly how they did it. Hi, I'm Sean Quinlan. Welcome back. Today we are walking through a step-by-step credit rebuilding plan after bankruptcy. Most people think bankruptcy destroys your credit permanently, but with the right steps taken at the right time, your score may recover faster than you expect. By the end of this video, you will have a clear, simple plan to follow. Let us start. Why this sounds backwards, but is not. Let me say something that sounds completely backwards. For many people, filing bankruptcy may actually be the fastest way to start rebuilding their credit. Not the slowest, not the most damaging, potentially the fastest. Here is why that makes sense. If you are drowning in debt right now, missing payments, maxing out credit cards, getting calls from collectors, your credit score is already taking damage every month, continuously. The problem is not going away by itself, it is getting worse. When a bankruptcy discharge is approved, something important changes. The debt is cleared, the missed payments stop stacking up, and your debt to income picture improves significantly overnight. From that point, if you follow the right steps consistently, your score can begin moving in a positive direction relatively quickly. Many people who follow a disciplined rebuilding plan have reached credit scores in the 700 range within approximately 2 years of their discharge. Not everyone will get there in exactly that time frame. Results vary based on individual circumstances, but the direction is clear and it starts with a plan. Today, we are going to walk through that plan, phase by phase, step by step. Phase 1. The first 3 months after discharge. The moment your bankruptcy discharge is approved, the clock on your rebuilding journey starts, and the very first thing to do within the first month is check your credit reports. You can get a free copy of your report from all 3 major credit bureaus: Equifax, Experian, and TransUnion. Go through each one carefully. Every account that was included in your bankruptcy should now show a zero balance. The status should indicate that it was discharged or included in the bankruptcy. This matters because of something called credit utilization. It is the percentage of your available credit that you are currently using. It makes up a significant portion of your credit score calculation. When discharged accounts correctly show zero balances, your utilization picture improves immediately. But here is the thing. Errors happen. Sometimes a discharged account still shows an old balance or an incorrect status. This can unfairly drag your score down even after discharge. If you spot any errors, you have the right to dispute them in writing with the credit bureau. Getting those corrections made can have a real positive impact on your score. This step is free. It just takes a little time. Do not skip it. Then around month 3, it is time to re-enter the credit market. Carefully and strategically. This is where a secured credit card comes in. The secured credit card strategy. A secured credit card is one of the most useful tools available to someone rebuilding credit after bankruptcy. Here is how it works. You deposit a small amount of money with a bank, maybe $200 or $300. That deposit becomes your credit limit. The bank issues you a card that works like a regular credit card. Because the bank is holding your deposit as security, approval is much more accessible, even with a bankruptcy on your record. Now here is the key to using it correctly. Do not use the card for big purchases. Do not carry a balance month to month. Instead, use it for one small, fixed, recurring bill. something like a streaming subscription that charges the same amount every month. Set up automatic payments from your bank account to pay the full balance every single month before the due date. That is it. Every on-time payment gets reported to the credit bureaus as positive activity. Month after month, you are building a clean, consistent record of responsible credit use. Simple, low cost, and genuinely effective when done consistently. Phase 2, months 4 through 12. This middle phase is all about one thing: building your payment history. Payment history is the largest single factor in your credit score calculation. It carries more weight than anything else. Every month that your secured card is paid on time, you are adding a positive mark to that history. Stay consistent. Do not miss a single payment. Keep the balance low. Let the months stack up. By around month 12, many people following this approach have seen their scores move out of the low range and into the mid-600s. At this 1 year milestone, there is one more tool worth adding. It is called a credit builder loan. The credit builder loan. A credit builder loan works differently from a regular loan. When you are approved, the lender does not give you the money up front. Instead, the loan amount is held in a savings account. You make small monthly payments over a set period, usually 12 months. Once the loan is fully paid, the money is released to you. Every monthly payment gets reported to the credit bureaus as an on-time installment loan payment. Why does this matter? Because credit scoring models look at the variety of credit types on your report. Having both a revolving account, like a credit card, and an installment account, like a loan, working well at the same time can positively affect your score. Many credit unions and some online financial institutions offer credit builder loans. They are worth looking into as a low-risk way to diversify your credit profile. Phase 3, months 13 through 24. This is the final phase, and this is where things can start to feel genuinely different. Around month 18, with a clean payment history building for over a year, many mainstream lenders may begin to view you as a viable applicant. At this point, applying for an unsecured credit card, a regular card with no deposit required, may become a realistic option. When you get one, treat it with exactly the same discipline. Low balances, full payments every month, no exceptions. Here is something interesting about why banks may be willing to lend to someone who recently went through bankruptcy. Think about it from the lender's perspective. A person who has received a bankruptcy discharge has no outstanding debt. They have a clean slate, and under federal law, they cannot file another Chapter 7 bankruptcy for 8 years. That means the lender knows this person has learned from a difficult experience, is rebuilding responsibly, and is legally restricted from walking away from new debt for a long time. For certain lenders, that actually makes a discharged bankruptcy filer a lower risk than someone carrying a mountain of existing debt. By the 2-year mark, if you have followed these steps without missing payments, your credit score may be in the range of 700 or higher. And at that 2-year milestone, something significant may open up. Conclusion: if this video gave you a clearer and more practical picture of what credit rebuilding after bankruptcy can look like, please give it a like. It helps this channel reach more people who are looking for honest, step-by-step answers. The next video covers the most common mistakes people make during the credit rebuilding process and how to avoid them so you do not accidentally slow yourself down. Subscribe so you do not miss it. Thanks for watching. You are in a better position than you think. See you in the next one. Take care.